Good afternoon. Hope you guys are having a great day. My name is Tyler Braun with the Tranel Financial Group. I'm one of our senior financial advisors. I appreciate you guys taking the time to listen in on this webinar. We're going to be talking about the CARE Act today. It's something that many of you have heard about on the news. In other terms, they call it a stimulus package. It's over $2 trillion that our government is putting forth to ultimately help stimulate the economy, stimulate the market, and really help small businesses and individuals get through these tough economic times. So let me do a screen share here, as I know working through technology, but let's bring it up here. So ultimately, the CARE Act stands for the Coronavirus Aid, Relief, and Economic Security Act. So that's where that CARES Act comes from. And as I stated earlier, it's a $2 trillion relief package that's been put forth to really help small businesses and individuals in particular get through these tough times. So it's one of the largest packages ever put forth by our government. And it's really something that they're putting out there that many of you might not know the nuances. There's over 880 pages of written document that goes through this. So today I'm going to be talking about three key pieces, right? Number one, required minimum distributions. Number two, 401ks. And then number three, should you or should you not convert to a Roth? And that's a question we've been getting a lot about. So over the last month in particular, with the volatility as it's really picked up, I've had a lot of conversations with our existing clients, a lot of conversations just with individuals out there that are lost in all of this information. And really, they're fearing the unknown. There's so much with this pandemic that we don't know. How long will it last? Where's the bottom of the market? They're seeking that clarity. And really, I want to bring you some clarity around those three talking points today. Obviously, there may be follow-up information or follow-up questions that you want to ask me in particular. Please feel free to reach out to us. We're doing this every day, so I'm glad to walk you through any specific scenarios that you have to help bring you some of that clarity that you're looking for. So with that being said, let's dive right in. Let's talk about required minimum distribution. So many of you have heard of the term and RMD simply stands for required minimum distribution. So in the year 2020, the tax year, this year of 2020, they have waived all required minimum distributions. So who does that apply to? That's a question that I get the most. So anybody who is over the age of 70 and a half, right? And ultimately they define that by those born before July 1st of 1949. So if you were born before July 1st of 1949, and prior to this year, when they changed the required minimum distribution age, you were over the age of 70 and a half, you're forced to take a required minimum distribution from any what they call qualified accounts. And a qualified account is simply a tax deferred vehicle, right? A qualified account would be an IRA, a 401k, a 403b, any vehicle that you had that is growing tax deferred and is an IRA or a qualified account, right, has a required minimum distribution. And that's a fancy term for an actuarial spend down, right? So what the federal government does, and they ultimately give everybody a life expectancy. And they look at your ending year balance of the prior year. So the December 31st balance every year going forward, they look at that balance from the prior year and they divide it by your life expectancy. And that's how much you're required to take out because they want you to pay your taxes on it, right? Anything you take out of an IRA or a qualified account is taxed at the ordinary income level. So the IRS wants their tax revenue. They changed the required minimum distribution age this last year to age 72. And that's where you see for those born after June 30th, 1949, they would also be required under normal circumstances to take a required minimum distribution. But for the year 2020, there is no required minimum distribution. They have suspended that on all qualified accounts. So in addition to that, if this was the first year, or if last year, if 2019 was the first year that you were required to take an RMD, okay, you had the ability to delay that until April. Some clients choose to do that based on tax planning. If that's the case, you can also delay that prior year RMD and the 2020 RMD. In addition to that, if you've inherited an IRA, so not a spouse. So let's use an example. A husband and wife are married, the husband passes away. If the wife is the direct beneficiary of that account, she can assume that IRA is her own. So that's not a spousal, or that's not an inherited IRA in that example. That is her inheriting or assuming that IRA is her own. So under circumstances where, let's say, your father passes away and you're the beneficiary of that account and you're inheriting a beneficiary IRA, there's a required minimum distribution that's still attached to that account where you're forced to take a distribution from that each year. Those have also been suspended for the year 2020. So they're not requiring any distributions to come out of those accounts in the year 2020. What they're doing with the volatility in the market that we've seen over the first quarter, they're allowing these to be in place so you're not forced to sell assets at a low. You're not liquidating shares and taking them out and depleting the account quicker than is necessary. So they're giving you something where they're allowing you to suspend that so you can keep your assets invested, keep your assets in place, and you're not forced to liquidate those down at a quick pace. So they're suspending all required minimum distributions as we talked about for the year 2020. Let's shift wheels. Let's start talking about 401ks. Many of the clients that we work with, many people that are out there have questions about 401ks. So we've seen the unemployment numbers come out over the past 2 weeks, and there's an immense amount of people that are being laid off or furloughed during these times. So what the government put forth with the CARE Act is they started putting things in place to allow you access to those 401k or IRA assets without penalty. Now, let me put out a full disclosure here. You do not want to pull retirement assets. A 401k or an IRA is a retirement asset, right? IRA stands for individual retirement account. That is an account that you are setting aside for retirement. You do not want to pull from those or deplete those if you do not have to. So if the market's down 10% and you take out a 10% distribution, your principal is now down 20%. You multiply the losses on the downside. We do not want to deplete accounts if we do not have to, okay? So when we're going through this, these are some of your last resort efforts that you would go to when you start diving into those retirement accounts. So let's look through some of these options that you have. So ultimately, individuals now have the ability to access funds inside of a qualified plan, and that's simply a fancy term for a plan through an employer or an IRA, just something that has qualifications attached to it, basically money that's supposed to be used for retirement. They can take a distribution that will be coded as what they call a CRD, a coronavirus-related distribution. And they can take up to $100,000 from that account during the year 2020, but it's supposed to be used for individuals that are affected by the coronavirus. So individuals that have been diagnosed themselves, their spouses or children have been diagnosed with it, or they're suffering from a financial issue or an adverse financial situation because of the coronavirus. So the way that they're coding this right now is the owner of the account themselves has to certify if they're eligible. So basically, if you're telling the government that you have the coronavirus or your spouse or child has the coronavirus, you're eligible. You are self-certifying that eligibility for that distribution. That comes into play, and that's a really, really big deal for those distributions when we look at it in terms of people that they might not have had their retirement fund where it needed to be, or they might not have had their emergency fund in place to where it needed to be, or they're laid off for a long period of time. So let's say they go through their 3 or 4 months of reserves and they're at a point saying, what do we do, right? We ultimately do not want to put money onto credit cards and high interest bearing accounts that we're going to be paying for years and years and years. So they're saying as an option, you can take from your 401k without a penalty, right, for that 2020 time period up to the $100,000. And this is the biggest piece of this writing. If you're under the age of 59 and a half, there's no longer that 10% early withdrawal penalty. So prior to the CARE Act, right, any IRA, any 401k outside of certain stipulations, 72T, or just taking distribution systematically if you're over the age of 55, we're not going to dive into those today. But generally speaking, if you were under the age of 59 and a half and you took a distribution from your 401k, you paid ordinary income tax and a 10% early withdrawal penalty, because that money is supposed to be for retirement. So they were penalizing you for touching it early. Well, now with this new option with the CARE Act, they're allowing you to take that 10%, or that, excuse me, they're allowing you to take that distribution from the 401k, but there's no longer the 10% early withdrawal penalty if you're under the age of 59 and a half. They do not want to penalize you further for being forced to take this distribution because of the coronavirus. In addition to that, if you're taking a distribution from a 401k or a qualified plan, they have federally, up to this point, they would have had federal mandated withholding of approximately 20%. So if you took a distribution out of the account, right? Let's say you needed $50,000 from the account. You took a $50,000 distribution prior to the CARE Act, they would charge you a 20% mandated withholding rate for that, and you would be hit with a 10% early withdrawal tax penalty. Now, if you took that same $50,000 distribution after the CARE Act, there's no mandated 20% tax penalty, and there's no 10% early withdrawal penalty as well. Now, full disclosure, if you take a distribution, it is still coded as taxable. If you take that $50,000 distribution out of the account, you will still pay ordinary income tax on that. You just now have the ability to stretch that payment over a 3-year period. Or it can be recoded back into the account over the next 3 years as a contribution. And that's a huge piece. So in that example, you take a $50,000 withdrawal and you can stretch out that tax payment that you would have. So let's say you're going to pay your 20% taxes because that's your tax rate on that money. So that's $10,000. You can stretch that $10,000 tax bill over a 3-year period to repay that, or you can recontribute back into your qualified plan over that same 3 years and not have to pay the taxes. It just shows as a recontribution or a rollover contribution back into the account. So it allows you to get some stability back into your financial realm and start building that your finances back up and making contributions back into the plan. They're not penalizing you for touching it in the short term. And if you're able to put it back over the next 3 years, they're allowing you to do that to avoid that taxation. That's a huge, huge benefit. Just a sidebar on here that the 401k plan in which you're working through needs to amend their program to allow for those coronavirus-related distributions. So they have to be amended. It's not something that's written in under a normal plan. Your employer would have to have that language written in order for you to take advantage of these options. Loans, right? And many people that have 401ks have heard of 401k loans. A loan is basically something that you're taking, right, from your 401k without taking withdrawal. You're borrowing from your balance. So previous to the CARE Act, right, so previous to the end of March, your loan was typically capped at about $50,000 or 50% of your vested balance inside the account. And they've changed that. So they're trying to allow for more and more people to have access to those short-term funds to allow them to get through this financial issue. So when we look at it, the loan amount has been increased from $50,000 all the way up to $100,000, or it can equal up to as much as 100% of the vested balance, which is increased from 50% of the vested balance. So let's do some quick math here. Let's say that you have $75,000 in your 401k, right? That's under the $100,000 threshold in which they allow you to withdraw up to. So you could take a loan for up to 100% of that vested balance in that example. let's use a different example and say you had 150,000 in that 401k, you'd be capped out or maxed at taking a loan of $100,000 because that's the maximum amount in which they would allow you to take a withdrawal from. So any loan payments that are due between March 27th and December 31st, so the date that the CARE Act went into place and the end of this year, for whether it's a new loan or an existing loan, you can defer those up to 1 year. So you do not have to pay on those. You can defer them up to 1 year. Once again, as a disclaimer, your 401k plan has to have those amendments in place to allow for this. You're going to want to talk to your 401k provider, talk to your HR people to make sure these are in place before you're making any decisions about that going forward. Lastly, Roth conversions. This is a conversation I've had a lot around. There's been articles out there talking about converting IRAs to Roths. Is it advantageous? Is it not advantageous? How do we do it? Why do we do it? And I thought it'd be good to just explain what a conversion is and then talk about some different strategies that we see or different options that people have to get the wheels turning. So a Roth conversion is basically taking a traditional IRA or 401k, right? And when you hear that word convert, that simply means you're paying taxes on that and converting it to a Roth IRA. So a traditional IRA, for example, is a pre-tax vehicle. It's money that you put in, whether it's into a 401k or an IRA, you added it to that account before paying taxes. And it grows every year, tax deferred. When you take distributions from an IRA, a traditional IRA, you will pay ordinary income tax on that money. So let's say you put $5,000 away every year for 20 years. That's $100,000 worth of contributions into your traditional IRA. And let's say it's worth $200,000 in that example. When you go to take distributions from that $200,000 account, that $200,000 IRA, anything that you take out will be taxed as ordinary income. A Roth IRA is a tax-free vehicle, meaning that you're putting in post-tax money you've already paid taxes on, and that money grows tax-free each year. So when you go to take that distribution, you will not pay any taxes on the gains at all. It's a very, very nice vehicle. So what a conversion is basically looking at that IRA and saying, is it advantageous to pay taxes now and move it into a Roth so any gains going forward would be taxed at a 0% rate. Any gains going forward once the conversion's in place in a Roth IRA grow tax-free. So let's use just some general samples when we work through this, okay? Let's say that you have $100,000 in an IRA. In a month and a half ago, it was worth $140,000. So you're down about $40,000 in the account. One of the things to think about it is the market is down, right? So we're trading at a low compared to where we've been historically over the last few years. And what we're looking at is, do you convert that? Do you take that $100,000 and convert it into a Roth IRA? And the reason for converting it is, let's say your $100,000 goes back up to 140. So you started with 140 a month and a half ago. The market dropped. Now it's worth 100,000. You would convert it to a Roth IRA. And let's say it grows back to 140 over the next year, year and a half. That 140,000 is 100% tax-free to you. So that means that you would have the ability in the future, if you needed it, to have access to those funds without taxes. Now, there's other provisions with Roth IRAs that we won't go through today. So always talk to your CPA or your financial advisor or planner before taking a distribution from a Roth. But just for conceptual example today, right, the gains inside the account would be at a 0% tax rate. You'd have tax-free growth, taking advantage of the decline in the market to gain tax-free growth on the upswing. That's one reason to do it, okay? So a few different strategies. I'll go over a few options with you here that we look at when doing Roth conversions. Number one, convert it to low so the gains can grow tax-free. That's what we just talked about. If the account is depressed, which most accounts right now are, we can do the conversion and allow those gains to grow tax-free where they wouldn't normally be doing that inside of the IRA. One thing we look at with that is you want to make sure that you're bringing money to the table and not withholding the taxes out of the account. So that's not every person. Not every person has the ability to do that. But when we look at that strategy, we're typically suggesting that if you're doing a conversion, you don't want to withhold the taxes from the account. So if you converted 100,000 in that example, and we withheld 25% for taxes for the federal government, now you're down to 75% or 75,000 in the account. You need a 33% gain in the account just to get back to 100,000 where you were prior to. So most of the time when you're doing a Roth conversion, if you have the money on the outside that you can bring to the table, right? Whether it's a reserve that you have in checking or reserve in savings that you can bring to the table and cover that tax bill. And this year, maybe your ordinary income level is lower, so you're in a lower tax bracket, meaning you have to bring less money to the table. And you can do that without taking the big step back in principle. It can make a lot of sense. Another strategy that we look at is just taking advantage of the waived RMD for this year. So you're used to, let's say you're a retiree, you're in your mid-70s, and you're used to taking that required minimum distribution from the account. Your taxes are set up for that. There's no real changes other than you're not required to take it. Well, instead of taking the RMD out, let's use that same strategy, but instead of coding it for the RMD, let's do a conversion into a Roth IRA. And what that will allow us to do is take that distribution, code it into a Roth IRA, and now you have tax-free growth forever on that, right? Meaning that you can leave that money to your beneficiaries. You have that ability to take that out down the road and not have to pay taxes on it. So ultimately, with that ability of waived RMD, if you don't need the distributions, and many retirees don't want to take the required minimum distribution, but they're forced to, let's take that, utilize a strategy to convert that to a Roth IRA and get that growing for you tax-free. So that's an option that's out there as well. So another thing I want to leave you with, and this is the third option, and I didn't pop this one on here, and it just popped back into my mind, is if you're a person who normally gets a big refund, right? So let's say you get a $5,000 refund and you're in a 20% or 25% tax bracket. So if whatever you convert from a traditional IRA into a Roth IRA is taxed at your ordinary income level, right? Now there's deductions and so forth. This is just an example, but work with me here. So if you take that $5,000 refund that you normally get, and you said, I don't have the money to bring to the table on the outside, but I get a refund on average of around $5,000 a year, we can convert and work with your CPA to convert enough money to make you get a break-even refund. So you're using that refund to bring to the table to convert that traditional IRA into a Roth. So let's say, for example, you get a $5,000 refund on average, and you're in a 25% tax bracket. 5,000 divided by 0.25 means you could convert up to $20,000 of an IRA into a Roth IRA, and your refund would cover that taxation. So that's just an example. It's just a strategy that you would need to work through with your CPA or your financial advisor, but I just wanted to throw that out there as well. So we covered a ton of information, right? We went through the CARE Act. There's 880 page, $2 trillion. I talked about just 3 of the scenarios that you would work through during that. And ultimately, we talked about RMDs. So in recap, the RMDs for 2020 are suspended. We talked about 401ks. You have the ability to take distributions from 401ks and IRAs, and you also have the ability to take enhanced loans from 401ks. As long as your employer and 401k allow for the amendment inside of there. And then we talked about Roth conversion. So this is in-depth stuff. Every person's scenario is completely different. So we're here, our whole team is here to help you. If you have any questions with any of these, if you're wondering, can I take a distribution? Should I take a distribution? Is a Roth conversion right for me? What do I do about my RMDs going forward? Give us a call, right? That's what we're here for. We're glad to help. If you have any questions at any time, please reach out. Once again, my name is Tyler Braun with the Tranel Financial Group. I really appreciate you taking the time to watch this video, and I hope you guys have a great rest of your day. Thank you.